Everybody, and welcome back to the Strategic Associates Studio here on the Teaching Tax Flow podcast. We are on episode 198. We're looking at a very special topic for those that fall into this, we'll say, category, if we will, of W-2 earners. That's right. If you know what that is, awesome. If not, you're about to find out as well. But we're taking that $100,000 or less in annual income. So why we say that, right? Because strategies are different amongst people with different income categories. We're not going to say brackets. We're going to say something else here too that we always do here on the podcast. But as always, Chris Picciurro, welcome back to your own show, sir. I know we have some top strategies here we're going to talk about for these individuals making $100,000 or less in annual income, correct?
Yes, we are. And for those that are earning $100,000 or less of W-2 wages, we're also assuming that they don't have a spouse or any other businesses or rental properties, which is the vast majority of taxpayers in the United States. And someone asked me just last week when we were met somebody new, and the person said, well, why did you create Teaching Tax Flow? And one of the main reasons is that we feel that tax planning and strategy is important to all households. I truly believe that that lower to moderate income households need this. They don't have access on a daily basis to tons of CPAs, estate planning attorneys, certified financial planners, and that's just kind of where it is right now, especially with people not coming into our profession. So we want to be able to serve the entire taxpayer community. The vast majority are going to be those households at $100,000 or less in our W-2 wage earners. So when we think about in the teaching tax flow system, if you are a $100,000 or less W-2 wage earner, and you are going to be what we call a green diagnosis in our system. Green means marginal, you nailed it, marginal tax rate of lower than 25%. Now, even if you're in a state that has a tax, typically the state taxes are graduated, and you're going to most likely not be in a really high marginal tax rate for the state. If we just look at someone, let's say, that has $80,000 of W-2 wages, or a household with $80,000 worth of W-2 wages, if it is a married filing joint couple, their taxable income without any deductions or credits or dependents is going to be, with the standard deduction, about $68,000 to $69,000. That means their marginal tax rate's 12% on the federal return. That's, again, before credits. If they're single at $80,000, they're going to get a standard deduction of $16,000. The point is they are in the 22% marginal tax bracket, but just barely. So think about this: $100,000 or less household income. You're in your green diagnosis. You're in a lower marginal tax rate. That doesn't mean $100,000 is not a lot of money. That is a lot of money. That is a good wage. It's just, for purposes of tax planning, it's a green diagnosis. Before we jump into what my 5 top tax planning implementations are for these type of taxpayers, we have to remember that your marginal tax rate. So if you said, well, I'm paying 22% tax, I'm single, I'm making $95,000. Remember that there are other things at play, and there are a lot of credits and deductions available to people in this situation. I'm not just, if you have dependents, even if you don't have dependents, you could be eligible for the earned income tax credit. If you have dependents, you could be eligible for the child tax credit, the child and dependent daycare credit. If you have dependents, or you're paying higher education expenses, American Opportunity Credit, Lifetime Learning Credit, the LLC, not the limited liability company, the Retirement Savers Credit, which is actually an amazing credit. We have a full episode on that, where the government gives you a 401k match, basically for free. They're giving you a credit for you putting money into your retirement account, and that includes even if you put into a Roth, which is after tax. And then there's the premium tax credit as well. So there's tons of credits available to folks. Also, people in this situation with the OB3, One Big Beautiful Bill Act, even if you have W-2 wages. I mean, John, let's say you have a W-2 wages of $90,000. You have a spouse that stays at home, as a homemaker and you have a dependent. But $25,000 of that was earned as overtime. This could easily happen. Someone in a trade union, a pipe fitter, a plumber, a carpenter, you know,
Bartender in
so
Vegas.
or they could be getting tips, right?
Mhm.
So for many of the people in this income threshold, that Schedule 1A, we have another whole episode on that, but all those Schedule 1A deductions come into play. The deduction for some tips not being taxable, overtime not being taxable, or if you're mature age and you're still working,
Right.
65 or older, there was senior deduction. Or you bought a new vehicle. I don't know if I'm in this situation, if I'm taking my assets and buying a new vehicle, but interest on a new vehicle is deductible. So my point is this, as we say all the time, marginal tax rate's important. Tax brackets lie to us. And not only are all the credits available to us, but all those other deductions are available to people in the situation. So just putting our mind there that you could be making $90,000 a year on a W-2. That person working your butt off. $30,000 is overtime. Where we're from, John, and right outside Detroit, this is a very common fact pattern, right? $30,000 is overtime. Dependent. Spouse is a homemaker. So right off the top, a lot of those W-2 wages are not going to be taxable due to Schedule 1A. You have the child tax credit. You have a big standard deduction. You could be paying, no joke, like $1,000 worth of tax on all of
Right.
that income. So what should you be doing then, right? How do you take advantage of this situation? Because you might be working at an employer that's putting money into a pension plan. So chances are your marginal tax rate when you retire, in the little example that I just made, maybe we'll make it, if we ever do Defeating Taxes Part 2, the book, we'll put a case study in there like this, or we'll create some more content with some cool case studies. What should you be doing, and how do you take advantage of that? Because there are opportunities.
And before we get into a lot of your favorite ones specifically, right? I think this one's really important. So even, if somebody's, I'm just making an assumption, if somebody's say making 80,000, or say they're making 60,000 a year, they're under the 100, which we're talking about here. They might be saying, all right, well, I'm going to tune off. I'm going to, turn this off. This has nothing to do with me. I don't need to tax plan anything. I don't pay a whole lot. You will one day, hopefully. And when it comes time to that, I would almost say, and Chris, tell me if you agree with this or not, one of the best components or cog in the wheel of tax planning is just even knowing what's out there, right? Not saying, hey, your first step needs to be call up and, get an advisor and get all these people if you don't have one yet. Just being aware of things that are going on and that you can be in control today, tomorrow, whenever. And honestly, I mean, not to plug ourselves, but to plug ourselves, shameless plugs, we have discussed all this stuff. So even if somebody's saying, I'm not ready for any of this, literally like flip on our podcast and go clean your house. I mean, go listen to these episodes and it just helps kind of change that mindset. So if that time comes that you're really ready to dive headfirst into tax planning and working with somebody, again, what that concept's all about, right? Is that a good way of saying that, Chris, you believe?
Absolutely. You could be in a situation where you're in your early 50s, maybe mid 40s to, let's say, early 60s, and you're kind of in your peak earning years.
This episode is sponsored by Wealth Builders Mortgage Group, powered by Movement Mortgage, one of the top mortgage teams in the nation and a powerhouse in the real estate investing world. With over $1.1 billion in closed mortgage volume and more than 3,000 investor deals under their belt, they don't just talk the talk, they walk it. Their team specializes in helping short-term and long-term rental investors scale smart with customized lending strategies. They offer all STR loan products, including second home, investment, non-QM, bank statement, asset-based, and HELOCs. They also offer all primary home loan products too. Whether you're just starting out or expanding an existing portfolio, their unique Path of 10 strategy is designed to help you move from a 9-to-5 job to financial independence. If you're looking for a lending partner who truly understands the investor mindset, visit wealthbuildersmortgagegroup.com and start building your roadmap today.
A lot of those people have children that are entering the workforce. A lot of my friends have children that just graduated from college and they are making $60,000, $70,000, $80,000 a year. And they've never made that much money because they've been bussing tables and driving Uber and all these other crazy things. or just being a student, and they're like, what should I do? I
Right.
anticipate, hopefully my children, when they enter the workforce, be that after college or after high school, whatever their path is, um, they they're gonna be in this situation, right? Yeah, I mean, 99 point, unless you become some type of world famous athlete or entertainer, you're gonna be in this situation when you start. And so yeah, so what would I tell them, right? What would I tell my own kids? And that's kind of how we think about things at Teaching Tax Flow. We really believe that, especially, I mean, in giving advice for 25 years now, I look at everyone's situation like, what would I tell my cousin? What would I tell my parents? Um, and
Well, shoot, you've been giving me advice for 20 something years. So there you go. There's case in
Look
point.
where it got you. You're on this
Yeah,
podcast now. It's a minor miracle.
I see that. If you can give advice to somebody that then has enough knowledge to get on a podcast to do this with you, I think you know your stuff.
Hey, that's not
So
too bad.
yeah, I'm doing all right.
Well, all right. So let's talk about the top five. Top five things I should do. Some of them might surprise you. Actually, that would surprise you actually. So first one is going to be my TriStar, because I reside proudly in the state of Tennessee. TriStar tax strategy, meaning tax deduction, tax-free growth, and tax-free distribution, is a health savings account. Now you might say, well, wait a second. I'm in a low marginal tax rate. Do I really need a tax deduction? The tax deduction is important with the health savings account, but what it's also providing you is that it's giving you a savings for medical expenses. Because if you're in this situation, it's going to be really tough to save money. It allows the money to grow tax free, and you might be just entering the workforce down the road. That, like, I wish we had this health savings accounts when I was 30 years ago, right? Even though I didn't have children, I wasn't married yet. What would have a couple thousand thrown in the account done? Now, now when I kids need surgery, and not, my daughter unfortunately tore MCL and ACL playing volleyball, and it's going to be an expensive endeavor. So, but the reason the HSA works well for these type taxpayers is this: you're probably at this income level not itemizing your deductions. Even if you have a mortgage, it's probably not a ton of mortgage interest that's going to be higher than the very generous standard deduction. So since you're not itemizing your deductions, you're probably not getting any type of tax benefit for your medical expenses. So you might as well put some money into your health savings account and sock it away and let that grow tax free. So health savings account. A lot of times you have an employer that puts some money in there for you, but I would put some money in your health savings account at this point.
And if somebody doesn't have an employer, anybody that does it for them, there's a ton of different avenues. I mean, in full transparency, I think ours is with maybe Fidelity. It took me all about 6 minutes to set it up.
Mhm.
So people can do things easy.
Absolutely. Almost every bank or credit union, at least banks you could set up that house savings account. Um, all right. What's number 2 and 3? So the second one is going to be making Roth contributions. So that could be either through your employer, or it could be outside of your employer. Why? Because we don't need the tax deduction today. We want that money to grow tax free. Now, if it's an employer sponsored plan, the vast majority of employers will allow you to put the employee, so your portion of the contribution, into a Roth component of your retirement plan, and then your employer matches outside of the Roth. Okay, so you're still going to have those pre-tax dollars, but they're not your dollars. And that's something that we talk about all the time with, with people in this situation. So I highly, highly recommend, when you're green diagnosis, Roth contributions, either through your employer or outside of your employer, in a Roth IRA. My third one is actually Roth related also, Roth conversions. So if you're in this situation and you have money in your pre-tax accounts, these are the years where you might want to convert that from a traditional IRA or a 401k into a Roth. We're going to pay the tax on it this year, but no penalty. So this is age agnostic, John. I can't tell you, there are people I know, and it's funny, I've met some people recently. They are actually very wealthy. They're working either at a golf club as a starter, they're in a retirement job, just having fun, maybe working 20, 30,000, making $20,000, $30,000 a year. They haven't turned on Social Security yet. They have millions of dollars in their 401ks. They don't necessarily need all that right now, but they know they're going to have to pay tax on that in the future. And especially if they are working, as somewhere where they're getting tips. The point is, they're not paying much tax on their current income. Their green diagnosis, they're more mature aged. They might even be getting the senior deduction. Let's do some Roth conversions now and start taking that money out of your pre-tax accounts and convert. Or if maybe you're in a younger stage of life, or if you have younger, if you have a family, and let's look at our guy, the $90,000 guy, and now, or girl, and their spouse is a homemaker. Now they could say, well, wait a second, I'm in the 5% marginal tax bracket. I put money away in my 401k the last 2 years. I probably shouldn't have. I probably should have went into the Roth portion. Guess what? There's a get out of jail free card. Let's convert that money at this point. So definitely talk to your tax professional, or use something, like a tax hacker or something like that, which is an amazing resource. I know recently we had the founder on the podcast, Bill Park, talking about this, and that's exactly, okay, maybe I should do some Roth conversions, and it's worth it to sit down or talk to a tax professional to figure that out, because we know that rule of 72. If we can convert a couple $1,000s now and you're young, that could be tens and tens of thousands of dollars in the future tax-free. So
I think the most important things that you say a lot, and this is perfectly for this audience, is tax-free income and growth. Like the and growth part is very important. So that's something to remember. And you mentioned that, it's way more beneficial in most cases that somebody pays the tax up front and lets it grow and grow, and then it's theirs, versus deferring that little bit, quote, air quotes, little bit of tax now, and then having to pay it later on a much larger portion. So
absolutely. And so those are things you need to consider. The number 4 and number 5 are going to be capital gain harvesting. So there are people that have money in their, let's say they have digital assets, right? Maybe they're horsing around. I shouldn't horse around, but maybe they invest in digital assets that have gone up. If you have something, you have capital gain, and you're in a lower marginal tax rate, these are the years to harvest those gains. That means sell the asset. Even if you want to keep the asset, sell it and reset your basis now at a very low tax amount. So let's say I bought a piece of digital currency at $1,000 and it's worth $5,000 now, and I think my earnings are going to continue to increase. I might be able to sell that for the $5,000 and have a $4,000 capital gain and pay no tax on it, because I'm in a lower marginal tax rate and I'm in the 0% capital gain rate. And then I'm just resetting the basis up to 5. And if it goes up to 8 later and you sell it, now you're only paying tax on that difference. So point is capital gain harvesting. Really think about that. And then my 5th one is to take a long look, and this is for anybody in this situation that is under the age of 40. Take a look at life insurance. Okay. I know if you're over 40, that doesn't mean you shouldn't take a look at life insurance, but take a look at it. Why? Because a lot of times people on this income threshold, they are getting started. They don't have a lot of retirement. If they have a spouse or a dependent, they are going to need them financially. If something happens prematurely to them, they're in trouble. Now, you could look at, I'm saying talk to a trusted advisor about their difference between term and permanent and convertible. I'm just saying take a look at it, because you're in general, you're going to be in pretty good health at this point in general. It's a modest amount of your income, but it preserves and gives preserves your family's financial foundation, really, if you're in that, because ultimately, if you're in this W-2 wage and bracket and you're younger, you probably don't have a ton of assets that you've accumulated. So you want to hedge that bet, and it might be temporarily to protect your family and loved ones. And those are my top 5. I'd say, again, HSAs, Roth contributions, Roth conversions, capital gain harvesting, and taking a look at life insurance.
Awesome. So hopefully anybody that's listening to this, you didn't know, I wouldn't say hopefully, most likely, and probably hopefully, that you didn't know all of those that even existed, nor did you get all the information for every single one of them here from Chris, the way you described it, right? Like we kind of hit the tip of the iceberg. However, in reality, you just got, and this is for anybody listening and or watching, you just got the bulk of what they are. I mean, sure, there's little tactics, strategies, all this stuff that bundles around these and they wrap, and you can do multiple things at one time. It's not always you have to pick one or the other. Check them out, Chris. I know you mentioned just talk to somebody, figure it out if you're ready for that. And again, honestly, I didn't even know a lot of this existed, Chris, until we've done podcasts on these topics in the past. So if somebody's thinking, oh man, I didn't know about this, I missed the boat. I was in the same boat as you. So don't think that you're the only one out there. But yeah, everybody check this out. Check out the other podcasts that we've done on these topics. Really, wherever you listen to these, just do a search and you'll see it's literally right in the topic. In the episode title of what we're talking about. So it's pretty easy to find them. Easiest one's obviously going to be on YouTube. Just go on our channel and search for it. You're going to find more than just the podcast episodes. You're going to find all kinds of clips and reels and everything on there. And then last but not least, go to defeatingtaxes.com. I'll put the link here in the show notes for us when we edit this out. Click on that, and that really is your gateway to all teaching tax flow resources. So, haven't said this in a while, but don't be lazy. It's right here in front of you. Check it out and have a great week. We'll see everybody back here again next week on the Teaching Tax Flow podcast. And here's a teaser. Now we're going to look at similar situations, but for those higher income earners. So again, have a great week, everybody. We'll see you soon.
The information in this podcast is educational and general in nature. It reflects the opinions of Teaching Tax Flow and does not take into consideration the viewer's personal circumstances. It is not intended to be a substitute for individualized financial, legal, or tax advice. Consult the appropriate qualified professional prior to making any decisions. Securities are offered and supervised through Cabin Securities Inc. member, FINRA, SIPC. Investment advisory services are offered and supervised through Cabin Advisors LLC, an SEC registered investment advisor. Chris Picciurro is a registered representative of Cabin Securities and an investment advisor representative with Cabin Advisors LLC. Teaching Tax Flow is an independent entity and is not affiliated with Cabin Securities or Cabin Advisors.